retrospective of the last 18 months and saying, hey, we did a very steep series of rate hikes and basically nothing broke and the economy has been relatively strong. And, most people are starting to coalesce around this answer that yes, on shorter dated yields, right? The 2-year and below and 2-year below, I mean, it's been a very steep increase, but the longer dated yields haven't moved very much at all. And so like how much emphasis do you put on longer, like the 10-year and the 30-year here moving up? And is that an issue for markets?
Yeah, well, I think the 10-year and the long end, out to the 30-year is the rate that is the most impactful rate on the economy, both because it typically sets the borrowing rate for most borrowers in the economy, whether you're borrowing, for a house or whether you're a corporate borrower at this point, is much more tilted towards the long end than the short end. Although there are some floating rate borrowers that are out there, particularly sort of private equity, private credit oriented businesses. But mostly the long end is business borrowing as well. So that sets the rate for credit creation. And it's gone up enough basically to slow credit creation substantially. There's basically no very, very little net credit creation in the economy, given the current level of interest rates. The other thing it does, which is probably more impactful these days, is that it sets the discount rate for all financial assets. And therefore, if that interest rate rises, then it affects basically all financial assets, stocks, gold, commodities, everything gets affected by it, credit instruments, et cetera. And so I think that's where its real effect is it going to put pressure on overall assets to fall, or is it not putting pressure on overall assets to fall? And so, we saw last summer, as the 10-year rose through to 5, we saw stocks fall, 10 or 15%. And that gives you a sense as to sort of what the sensitivity is of the economy to those higher interest rates. So it's a critical component of whether or not we're going to get an asset price decline here.
And so, right now, if you look here, let me see if I can pull up this chart of the last of the 10-year over the course of the last year. Not that I'm some kind of TA guy drawing lines on charts, but I mean, it is interesting to watch. Yield spiked at over 5% back in November of this last year, and it looked like it sort of bottomed there, and it's been steadily climbing, and now we're at back above 4.6. And admittedly, the 10-year and the 2-year both sold off today after the FOMC, which again was probably interpreted as relatively dovish, but it does look like yields are starting to climb back up. And I guess my question to you would be, do you see a sustained rally here, or are yields going to turn back around, do you think?
Yeah, well, I think the trouble, and this sort of connects with the issuance point that we were talking about before, is that every day what's happening is the government is coming to the market, issuing bonds and issuing bonds and issuing bonds, and every day they've got to get somebody to buy those bonds. And how do you get somebody to buy those bonds? Well, you have to get them to buy it at a higher yield or a lower price. And so that's essentially what we're seeing here. Is it's like water drip torture on the bond market, that day-to-day flood, that day-to-day issuance of bonds. And I think one of the challenges is because it's such a big issue, the Treasury is such a big issuer, that no one can front run it. Like, I could tell you that the Treasury is going to issue, $3 trillion of gross coupons over the course of the end of, between now and the end of the year. And like, who's got the balance sheet to pre-position for that? Like, basically no one. And so that's why it ends up being like, it feels a little, it feels a little disappointing when these things happen, because you're like, nothing really happened in the market that day. And then every day you come in, you see these pressures on bond yields that we've seen, in the, for the last, since the start of the year.
Yeah. And so where do you think this ends? Because, if you look at estimates from, even the CBO, the Congressional Budget Office, all you see is continue at I think it's something like $2 trillion a year that has to get funded from somewhere. It's going to be the Treasury issuing more and more yield. So do you, or more and more bonds. So do you see sort of consistent pressure on yields to go higher from here? And if so, how does that sort of doom loop stop?
Well, I think we're in a challenging point, because the yield rises that we've seen so far are enough to start to cap asset price appreciation, which we've seen, stocks have basically peaked and traded sideways to down a little bit. But the yields are not high enough to create a slowdown in the economy, which would then start to create a demand or a bid for those bonds, say relative to stocks.
Mm.
And so in this transition period, it's almost like we're in in a gap. We're moving through an air pocket where stocks are too high and bond yields aren't quite high enough to create the easing to then turn them around. And so you need to get bond yields to move up enough to create enough pain on stocks to create the easing to then create the bid for bonds. That's how these markets work, is they're reflexive in that nature, right? And so we probably need bond yields in the 5.5 range to start to get enough of that slowdown in the economy to start to make sense to then go long those bonds. So we're in an empty spot right now, it seems.